Hey everybody, welcome to lesson 14 of the Strat course. Today we are going to talk about gappers. And in my opinion, gappers is a strategy more for advanced stratters, not so much the new stratters. And the reason for it is because they're very volatile and it's kind of a strategy all on its own because these do not have daily actionable signals or daily triggers because they can't. Because what happens is a gapper usually jumps so far up or down from the previous day's close that there is no actionable signal. Gappers occur usually due to a news release or earnings, and it's a big shock to the system. And for me, for it to be a real gapper, it must open nowhere inside the previous day's candle. So it cannot open between the high or the low of the previous day. So there must be a gap, if you will, of space between where the stock is opening and where it closed the day before. So where this day closed and this day opened, there is that blank space on the chart. So to me, that's what I want to see. You don't want to see it open inside the previous day, otherwise it's not gapping on the daily chart. So since there is no daily actionable signal to trigger you into a trade on a gapper, gappers are heavily dependent on other strat principles. So the ones that you really want to kind of focus on are daily time frame continuity. So what color is the daily candle? Exhaustion risk, and then intraday actionable signals. So if you look at Uber on the daily chart, the previous day closed right there at 34.90. Okay. And then we opened up here. So I know, try to envision this whole candlestick doesn't exist because all you know at the open is that you're opening way up here. Okay. So when you're playing a gapper, you always want to look left on the chart to see if you're at potential exhaustion risk because you've hit some sort of important pivot high. So we will label this potential exhaustion risk. So we gapped up, we took out that high, okay? And then we know, based on the lesson on time frame continuity, where you are relative to the candles open determines if the day is going to be red or green. A general rule of thumb for gappers, and of course, a rule of thumb is just that. It doesn't happen 100% of the time, but a general rule is that gap ups are for selling and profit taking, and gap downs are for buying and accumulating. And why would that be? And if you think about it from the position that you're the trader, and say you took a gamble that Uber earnings were going to go up, so you bought, a lotto call. Well, when the day opens and you were right and it went up, what do you as a trader want to do? You want to lock in profit, right? So you're going to sell your position, as are most people, because they got what they wanted. The chart gapped up, they were right, they're exiting their positions. And same thing with the short side. If you were betting that Uber was going to gap down because of earnings, and it did, what are you going to do? You're going to close your position along with people wanting to buy the dip. So that is the general rule of thumb. Gap ups are for selling, gap downs are for buying. However, daily time frame continuity is going to let you know if that's happening or not. Because on a gap up, you want to see a red candle. On a gap down, you want to see a green candle. And why do people want to play gappers? So the more advanced people want to play gappers because they tend to be very volatile and move a lot. especially if you're in a low volume, low volatility market where things aren't moving that much. You can always count on the gappers to provide you some volatility. Gappers also tend to be more of a day trading / scalping strategy, but sometimes if you get a really good one, you can enter a position and hold on to it all day if it's just going to keep going. So a small day trade can turn into a whole day trade if you get a good entry and you have a clear target of where you think price is going. And speaking of targets, most targets when you're playing a gapper are going to come from intraday price action because there's no really other price action around. So it's going to come from your actionable signal strat setups on the intraday smaller time frames, right? And then another target methodology is the gap fill, because we know the market doesn't like to leave holes, so it's going to want to come and fill this hole, because remember, this whole candle doesn't exist. It opened here, and then throughout the day it's going to build its price action, and then a gap fill target is always a major target for gappers. Now, if you're a pretty advanced stratter and have fast executions, you can trade reversals or strat setups in the direction of daily time frame continuity on the 5-minute chart if you want. And for the not so advanced stratters, I would recommend you stay on the 15, 30, and 60-minute charts. So let's kind of dig into this chart a little bit. So we already know that we gapped up, we opened up here, we know we're at potential exhaustion, okay? And then we know that anytime we're below the open, the day is red, and we want to be trading to the short side because we have upside exhaustion, and we know that when we're at upside exhaustion, we're looking for bearish exhaustion strat setups. Okay, we know we have a gap fill target. Okay, so let's go into the smaller time frames and see what we can see. Okay, here we have the 5-minute time frame, and the previous levels from the daily chart are still on this chart. So that was our exhaustion level, and this was our gap fill target. So again, knowing that we're trading below the open, we want to be looking for bearish strat setups because we have daily time frame continuity that is red. So we want to be trading with that knowledge. All right, so what is the first bearish strat setup that we see? This is a 2 up because technically it broke the high of the previous candle. What is the very first short bearish setup that we have? If we go to the sheet, we're looking for the bearish. We have a 2 up is the first, that would be our trigger candle. So this is a 1, doesn't apply. This is a 1, doesn't apply. Here we go. We have a 2 up. So we need a 2 up and then a 2 down. So this is the strat setup that is very first offered to us. Okay, so you're in on the 2 up, 2 down. We have no other nearby targets, so we kind of have to default to the gap fill, right? What's the second? You have 2 down, 2 down. These are not actionable. 2 down, 2 down, 2 up. So here's your corrective activity, right? A counter trend move, and it's counter trend because we have red full time frame continuity. So this is corrective activity. Okay, then what do you get? You get an inside bar. Is an inside bar an actionable signal? It is. What is it? It's a 2, 1, 2 down. So we know that our entry is below the 1. Okay, so our second entry is right here. Our target is the gap fill, okay, which you hit right here, which means you should be all out right here. 4.5% or $1.66. Okay, here I want to talk about a gap fill and then go. So Tesla on the day, it did gap. So we closed the day here and then we gapped here, which means on the open, there was a gap of air on the chart that looked like this. You have to look at this candle and imagine the life of it. So it opened here and that was it. So all you know on the open is the open. So you don't know if it's just going to fall apart or if it's going to want to go and fill that gap and then fall apart. And here's a good example of a gapper that you can find targets other than gap fill targets by looking left on your chart and getting your targets from the daily candles. So obviously, if you are of bearish bias, your targets are going to come from candle lows. And if your gapper is bullish biased, your targets are going to come from the candle highs. All right, so here's the 5-minute chart of Tesla. We already know that that was our daily open because we marked it from the daily, and we know that that was our daily gap fill. Because I want you to imagine in real time. So the day is here, the daily open is here, and the daily color at that time was green. The first strat setup was a bullish 2 down. This is a 2 down because we broke the downside of the previous candle, and then a 2 up. Okay, that is actionable. However, it failed. So this is telling you and showing you that the ability to push higher is being rejected. So you have to be prepared to stop out. So your stop would be a 50% stop. Okay. And when you get this failed 2 up, not only are you going to stop out, you're going to flip short because you have a bearish setup. So you want to take this because the upside failed. So now you're switching teams, you're on the bear side. So now you want to go short. 2 up, 2 down. There's your trigger. Remember, we're bearish now because we're trading below the open. 2, 1, 2 down. Perfect. Actionable. This got a little hairy. So maybe you had your stop here, top of that candle. Or maybe you were walking your stop down the highs of the candle because we haven't had corrective activity yet since the top, since the high of the day. And we know that when we're in a strong trend, we want to see corrective activity, and then we can use a trend-based stop. This just went continuation, and every single candle had a lower high. So maybe you want to keep your stop tight because you know corrective activity is coming. Maybe you get stopped out here. This looks like 15-minute corrective activity, which you should be monitoring multiple time frames. But this 2 up, 2 down failed. You would have been stopped out when you went 2 back up. So what do? It's okay. You re-enter again. It back tested the daily open, and we're still trading under the daily open. So we still have full time frame continuity on the daily in our favor. So we're going to try again. 2 up, 2 down. This one works. Again, if you like, you can even trail your stops down each candle's high to lock in that profit, because you can always lock in profit, and then we can always what? We can always get back in. So again, gappers are volatile. So you want to take the gains while you have them, be protective. It's totally fine to trail your stops to the highs of candles because you don't know how high corrective activity is going to go, and maybe you don't want to sit through it. Okay, so say maybe you entered here, you stopped out here, you let corrective activity happen, you go again. 2 up, 2 down. Now your stop, I would put at this trend-based stop because hopefully that's the top of the corrective activity. Trail down. Okay, maybe you get stopped out here because you're trailing down the 5-minute highs. Okay, and then you wait for another actionable signal. 2. It only broke the high by a penny. Maybe you got stopped out, maybe you didn't. It couldn't hold above it, so back down, boom. That was your daily target right here. Okay, here is QCOM daily. This is an example of a gap down. So on this day, the low of the day was here, okay? And then whatever, it had earnings, so it gapped down, and the daily open was here, okay? So when the day first opened, you had a gap or space of air on your chart. So this qualifies as a nice gapper play, okay? And then in the strat, what are we doing? We're always looking left and seeing if we're at exhaustion risk compared to where we're opening. And you can see you have this pivot low right here. It's the lowest candle of the surrounding candles, so that is a pivot low. So that is your what? That is your potential exhaustion level. Now we know, looking back, it opened here, it closed here. But how did the wicks happen? Okay, the wicks happened because it opened here, traveled down, took out the people who had stops here, and then reversed. Okay, but knowing what we know now, how does that help us intraday? So you'll have to go into the smaller time frames to figure it out. So we know that this would be our gap fill, because remember, this part of the candle doesn't exist yet. Come the opening bell, all you know is that you're opening here, you have a gap fill here, and you have potential exhaustion risk here. So let's go to a smaller time frame and see what happened. So we had our daily levels marked. Remember, this was the gap. So we opened here. We know our exhaustion level. Remember, that was that pivot low on the daily over here. All right, so the first 5-minute candle opens. It does what? It travels down, hits that exhaustion level, wicks up, goes back above the daily open. So now the day is green. So what's your actionable signal? The first bullish actionable signal, because again, we're at downside exhaustion. So we're looking for bullish exhaustion reversals. You have a 2 down. So the only possible actionable signal, so you're looking in the middle here, has to start with a 2 down. So here it is, 2 down, 2 up. That's what we're going to take. Okay, 2 down, 2 up. We have our gap fill target. Okay, so it hits that. You can take your profit all there if you want. And then if it's going to keep going, you need to go and find other targets. And how do we do that? We do it by going to other time frames and looking for targets. And what do we know about targets? They are, if we're bullish, they're going to be the highs of previous candles as we look left. So remember, all this price action you're seeing doesn't exist yet. Okay, so you are forward thinking and plotting your targets, and you know that they're candle highs. So you're just going to place targets at each candle high, because it's important to know if you're going to hit your targets or if you've hit all of your targets and you're exhausted. Okay, so I'm back on the 5-minute chart, but I got my other targets from the 15-minute time frame. You can even get them from the 5, but I kind of prefer the 15 when you have that pivot machine gun look that we had. Okay, so what happened? We filled our gap, which is your main target. So if you hadn't exited here, you sure would have wanted to exit when you got this potential exhaustion reversal in the form of a 2 up, 2 down, because you know you're at possible upside exhaustion now because you filled your gap. So you cut your whole position here if you didn't take profits here. Okay, then what? On the very next candle, you get a two down continuation that fails and goes 3. Is that actionable? It sure is. So you can get back in long at the 50% mark, right? Because that's a 1-bar rev strat. The day's still green. We're still very green on the day. So you can still look for actionable signals. And in a bullish 1-bar rev strat, you're entering at 50% of the previous candle with your stop at the low of the previous candle. Okay, you can take more profit right here, or you can just trail your stops up the lows of the 5-minute candles, because you know price can't reverse until it shows you it's going to reverse by breaking a previous candle's low. So what happened here? You hit 1, 2, 3, 4 out of 5 targets before getting a 2 up, 2 down reversal against you. This almost went outside day. That would have been that level up there. So again, here's an example of a gap down for buying, and always paying attention to possible exhaustion risk, like we found on the daily, knowing where exhaustion levels are, and playing in the direction of daily time frame continuity. So here's an example that didn't follow the rule of thumb that gap downs are typically for buying. This is when you are definitely going to use the daily time frame continuity. You're going to keep this in mind. So Lyft on the day had earnings, gapped way down. So we closed here at 1622 and we opened here at 1115. This was a 31% drop. So what do we want to do? First and always, we want to mark our daily open, and we want to search for potential exhaustion. Okay. And what else do we want to do? We want to get our targets. Anything below the open is going to be a target. And remember, if you're downside biased, you're targeting the lows of the candles. Okay, so what happened with Lyft? Why didn't the buyers step in and buy this dip? I don't know, and you don't know, and it doesn't matter. But if we had to guess, that 31% drop probably really scared any potential investors, and they probably didn't want to buy. But again, it doesn't matter. All that matters is time frame continuity and actionable signals in the direction of time frame continuity. Okay, here's Lyft on the 1 minute. This one was a little trickier, but opened here. The very first 1 minute stick was buying, and then on the second flip, we got a continuity change back below the daily open. So this would be a more advanced method, which is a continuity flip. So the day, when the first 1 minute candle closed here, the day would have been green, right? Because we were above the open. And then the second candle of the day flipped and instantly went red, trading back below the daily open. And this is what a lot of traders in the technical analysis world will call a green to red move. We just call it a continuity flip. If you're very aggressive, play the continuity flip, and then your stop would just have to go right up here at the high of the day, because you're expecting the day to turn red and not go back green. So you would not want it to go back above that high. Okay, and then this thing just tanked till it hit your second daily target. But this is a great example of daily time frame continuity in trading, how you know if the gap is going to get bought up or if it's going to get sold off. It all has to do with where we open. You got a 5% move in 5 minutes. So this is also why people love to play gappers, because they are so volatile and they move so fast on the open. Also another reason why it's more of an advanced strategy. You have to be fast. You have to know what you're doing. You have to be prepared to stop out if you're wrong and they want to change the daily color relative to the open. Okay, I think I'm gonna call it here.